Hello everyone. In this chapter we're going to talk about debt. We're going to talk about general long-term debt of local governments. Now in general, long-term debt is a very traditional part of governmental fiscal policy. Debt is actually used for long-term construction projects. This is very, very common. As we saw in the prior chapter, the Capital Projects Fund, you can see that governments typically will go and borrow money from the bank or borrow money through a bond indenture to start the project. Now the good thing is when the governments pay back principal plus interest, the interest that they pay their bondholders is generally tax exempt. So that is certainly a good thing for the bondholder. They don't need to report it on their tax returns. And at the state and local level, you will see that state and local levels have limits on the amount of debt that they can issue. So we're going to talk a little bit about debt ceilings and debt limits. And because of the tax exempt feature, you're going to see that a lot of the interest rates the government pay are a little bit less than the private sector. And so that is a good thing for the governments. They don't have to pay as much in interest as a for-profit business would. All right, so this is just saying that governments use debt in basically in their financing policy. The liability itself, we are not going to see in the actual debt service fund. The general long-term liability will be recorded in the government-wide statements only. They will be recorded as a liability in the governmental activities column. In the debt service fund, that's where we are going to actually record the payments of the principal and interest of the general long-term debt. Now, do you see I'm using the word general here? Because if there is debt of a proprietary fund or a fiduciary fund, they are going to record their own debt and their own payments. The debt service fund is only to pay back the general debt, to record the payback of the general debt. All right, now, why would a government actually borrow money? Now, we're talking a lot in this class on the financing activities, the bonds, notes, leases. We enter into bonds to build the new project, or notes to build the new project. We enter into a capital lease. Those would be reasons to issue debt. Now, there are other operating activities as well to issue debt. Maybe there's some claims or judgments against the government, maybe some pension issues, some environmental issues. They are typically less common to borrow money for, but certainly it does happen from time to time. All right, once again, the long-term liability itself is not recorded in any governmental fund. The actual long-term liability will be reported in the government-wide statements. If it is a general long-term liability, it will be recorded in the governmental activities column. If it is a proprietary fund, an enterprise fund liability, let's say that, it would be reported through the business type activities column on the government-wide statements. But in this chapter, we're going to concentrate on the general long-term liability. This is just a little vocabulary, so you're used to it. The debt limit is actually the ceiling. That is the total amount that they could possibly borrow by law. All right. The debt margin is the difference between the actual debt level and the debt limit. So obviously, the lower the actual debt is, the higher the margin is. All right. So let's take a look at some debt service funds. Before we do so, let me explain the difference between a serial bond and a term bond. A serial bond is when we pay back principal in a series of payments. So let's say we make a bond payment every 6 months. So if we pay back interest only in a payment, and then the next payment it's principal plus interest, that would be considered a serial bond, where we're making our principal payments in a series of payments over a number of years. Versus a term bond is when during the bond payback period, we pay the bondholders interest only, but at the end of the term, we actually have to pay back all of the principal at one lump sum. All right, so here are some journal entries. So we can see the debt service fund. First journal entry of the year is to record the budget. So what we're looking at first here is the actual serial bonds. So we will record the budget for the revenues as a debit to estimated revenues. We will record the budget for the expenditures, also known as the appropriations. We will record that with a credit. And whatever is needed to balance the journal entry, debit or credit, to estimated other financing sources. Now the government goes out and they receive sales taxes. So you can see journal entry 2A to record the sales tax coming into the debt service fund, debit cash, credit revenue. And at the same time that the debt service fund is recording that journal entry, you can see in the government-wide statements, the government is debiting cash and the credit goes to general revenues. And once again, 2B is recorded on the government-wide statements at the same time that journal entry 2A is recorded in the debt service fund. Keep in mind that the revenues at the government-wide level have to either be program or general. In this case, all taxes levied, and we see that here, are general revenues. Okay, now the debt service fund receives a transfer from the capital projects fund. I don't know if you remember this, but at the end of the capital projects fund chapter, there was $6,000 left over, and that money got transferred out to the debt service fund. And journal entry 3, as you can see, is the transfer from the capital projects fund. Debit cash, credit other financing sources. Please note that there is not a journal entry in the government-wide statements at this time. The reason for that is because the capital projects fund is transferring money out and the debt service fund is getting the transfer in. Since the capital projects fund and the debt service fund are both governmental funds, they net each other out. It nets to zero effectively at the government-wide level. Okay, now the first interest payment in journal entry 4A in the debt service fund, debit the interest expenditure, credit cash, and at the same time the debt service fund is recording that journal entry in the government-wide statements. Very similar journal entry, debit interest expense, credit cash. Now we come to the end of the year. And at the end of the year, because the government-wide statements uses accrual accounting, they will actually need to debit the interest expense for the accrued interest from the last interest payment date to the end of the fiscal year. This is a very similar journal entry that you learned in your other accounting classes, and we will credit the liability called interest payable. Please note that there is not a journal entry in the debt service fund to accrue for interest at the end of the year. That is because one of the modified accrual rules states that expenditures are recorded when they are due, and there's no year-end accrual for, in this case, interest. All right, interest is not due at the end of the year, therefore we are not going to record expenditures. So there's a timing difference between when expenditures are recorded, which is basically when they're due, and expenses. Expenses at the accrual accounting for the government-wide will be recorded when they are incurred. There is a difference between incurred and when they're due. Journal entry 6A and 6B are the closing entries for the year. We have to close our budgetary entry, as you see in 6A. The appropriations, which were opened with a credit, are now debited, and vice versa. And also the closing entries for the operating nominal accounts. As you learned in all your other accounting classes, revenues will be closed with a debit, so will other financing sources. Your expenditures will be closed with a credit. The difference will get closed out to fund balance. In this case, please note that fund balance is restricted. And the reason it is restricted is because everything we are receiving is from third parties. All right, so that is a restricted fund balance. That's the first year. The second year, once again, we start the year with a budgetary journal entry. We will debit the estimated revenues. We will credit the appropriations, and to balance the journal entry, debit or credit, whatever is needed, goes to budgetary fund balance. Now, sales taxes are generated. When they do in the debt service fund, debit cash, credit revenues, and at the same time the debt service fund is recording that journal entry. You can see the government-wide statements, debit cash, and the credit goes to general revenues. Once again, all taxes are considered general revenues. Okay, journal entry 9, and you can see this is a payment of principal and interest. I think this is a very important slide, probably the most important slide in the entire presentation. You can see massive differences here between accrual accounting at the government-wide level and modified accrual accounting at the governmental fund level. First, let's take a look at the journal entry in the debt service fund. We are required to make a $96,000 debt payment. Out of that $96,000 payment, $60,000 is for principal and $36,000 is for interest. But as you can see in the journal entry, both the principal payment and the interest payment are both expenditures. Remember, the long-term liability is not recorded on the debt service fund. So there is no debiting the liability. It all gets debited to expenditures. Now let's compare that to the government-wide journal entry, which uses accrual accounting. The same $96,000 payment, so we have the same credit to cash for $96,000, but you can see the debits are all different. All right, first, the $60,000 principal payment will indeed debit the bonds payable. Remember that the liability was recorded at the government-wide level, so when we pay back the principal, it will get debited. Now, if you recall, at the end of year 1, a couple of journal entries ago, we actually accrued $3,000 of interest at the end of year 1. Well, the payment of the $36,000 interest, $3,000 is to debit the last year's interest payable accrual at the end of the year, and the other $33,000 is a current period expense. Now, if you compare 9A versus 9B, we have reconciling items, don't we? At the fund level, we have expenditures totaling $96,000. But at the government-wide level, we only have expenditures totaling $33,000. Okay? There is a $63,000 difference. Effectively, the fund balance, or the equity at the fund level, was reduced $63,000 more than the net position, or the equity at the government-wide level. This $63,000 difference we are going to see in the reconciliation from the fund level to the government-wide level. And that is very important to understand. All right, and here we go at the another payment. In this case, the next payment is for interest only. So the debt service fund would debit the interest expenditure and credit cash. And at the same time, the debt service fund is recording that. You can see a very similar journal entry in the government-wide statements. The debit is going to go to interest expense and the credit goes to cash. These are effectively the same journal entries. We just have different vocabulary. At the fund level, we call them expenditures, and at the government-wide level, we call them expenses. And once again, at the end of the next fiscal year, which we have here in Journal Entry 11, we will accrue interest from the last interest payment date to the end of the fiscal year, and that equates to $2,850, debit interest expense, credit interest payable for the government-wide statements. Please note that there is no accrual at the debt service fund level, because at the debt service fund level, using modified accrual accounting, expenditures are only recorded when they are due. There is no accrual at the end of the year. And of course, this would result in a reconciling item. And at the end of year 2, here are our closing entries. A closing entry to reverse and close out the budget, and of course to close out our operating accounts. Close revenues with a debit, and we will close our expenditures with credits. All right, so I just took you through 2 years worth of transactions for a serial bond. Now let me take you through some journal entries dealing with a term bond. Now the interesting thing about a term bond is there's not a lot of payments. There's interest-only payments during the term, and it could be a 30-year term. All right, a lot of bonds are 30-year bonds. And we don't need to make a balloon payment for principal until the absolute end of it. Now here's the deal. Do you want to wait until that 30-year mark and realize, oh no, we have a large payment to make? And the answer is absolutely not. So what we're going to see a lot with term bonds is that a lot of times the government is going to earn money through sales taxes or what have you during the 30-year period. But basically what they're doing is, even though they're collecting revenue and recording revenue, they actually don't need to pay it out until the end. So what I'm trying to say is that a lot of times with term bonds, we are collecting more cash than we need currently because we're trying to stockpile it. We're trying to save it for the end. So a lot of times you're going to see with a term bond, you're going to see investments. Yes, there's that much cash lying around that we might want to invest it and actually earn a little bit of interest. And that certainly will help at the end when we have to pay back the principal. So here are the journal entries. First journal entry of the year with the term bonds, just like we saw with the serial bonds, is to record the budget. So our budget will be debit estimated revenues for $117,000 and change. We're only expecting appropriations of $75,000. And this just proved my point. We're expecting a lot more revenues than expenditures, which is typical for a term bond. Okay, once the budget is recorded, and the budget is only recorded at the governmental fund level, now we record the actual tax levy. So we send out a tax levy of $120,000. We will debit the receivable for that gross amount. But as we learned in a prior chapter, we will credit revenue for the net amount we believe we're going to collect. This is called the net revenue approach. And so revenue will be credited, in this case for $117,000. The difference between the gross receivable and the net revenue we believe we're going to collect, in this case $3,000, would be recorded as a contra receivable. And that contra receivable will be called estimated uncollectible current taxes. As the debt service fund is recording that journal entry, we can see on the government-wide statements a very similar journal entry is recorded. The net revenue approach is also used at the government-wide level. The only difference in these two journal entries is, as we said earlier, at the government-wide level, we have to note whether our revenues are considered program revenues or general revenues. And as we've stated earlier, all taxes are general revenues. Okay, now we make an interest-only payment, and you can see journal entry 3A, and the debt service fund, debit interest expenditure, credit cash. At the same time, the debt service fund is recording that journal entry on the government-wide statements. We are going to debit interest payable and credit cash. This is very important because what happened, even though I did not show it to you here, in the prior year, we actually had to accrue for this $37,500 as an expense at the end of the prior year. That's why when we make the payment in the new year, we're going to debit interest payable instead of interest expense. Once again, there is a difference. Interest expense at the government-wide level, using accrual accounting, we would record the expense when incurred. But at the debt service fund level, the governmental funds use modified accrual accounting. And with modified accrual accounting, the expenditures are recorded when they are due. And there is a difference in this case. This is a $37,500 difference between how equity is affecting at the debt service fund level, equity is going down by $37,500 because of the expenditure, but at the government-wide level, there's no effect to equity. All we're doing is decreasing an asset and decreasing a liability. This would result in a reconciling item. All right, journal entry 4 and 5 we can see is exactly the same at the fund level as well as the government-wide level. We are receiving some of our tax money, so we're going to debit cash and credit tax as receivable. And because a lot of that money we do not need currently, we can actually lock it up and invest. So you can see journal entry 5, we're debiting an investment and crediting cash. Journal entry 6A, we're receiving some investment earnings on that. So on the fund level, debit investments, credit revenues. At the same time, at the government-wide level, debit investments and the investment earnings would be considered general revenues. Now we're going to make another interest payment on the debt service fund, debit interest expenditures, credit cash. And at the same time, the fund is recording that. The government-wide statements will debit interest expense and credit cash. Pretty much the same journal entry, just a little vocabulary difference. And once again, some monies are collected, same journal entry in the fund as well as the government-wide, debit cash, credit the receivable. And because we don't need all of it, we will invest some of it. So also we will follow up with an investment by debiting investments, crediting cash. And last but not least, we made it to the end of the fiscal year. So at the government-wide level, using accrual accounting, we will have to accrue for interest from the last interest payment date to the end of the fiscal year. And that will be a debit to the interest expense and a credit to the interest payable. Note that there is no accrual at the governmental fund level, and that is because the debt service fund uses modified accrual, and expenditures are only recorded when they are due, not when they are incurred. Okay, so that would indeed result in a reconciling item. All right, some more interest earnings. Debit investments, credit revenues, and at the same time the fund is recording that. The government-wide statements, fairly similar journal entry, debit investments, but the revenue journal entry would be a credit to general revenues. Now some time went by and the taxes that we levied, the current periods is now overdue. And so what we are going to do is we are going to take our current taxes receivable account, whatever hasn't been collected up to this point, $4,600 has not yet been collected. So we will get rid of our current taxes receivable with a credit, and we will replace it with a new account called delinquent taxes receivable. And we will also do the same with the contra receivable. We will get rid of the estimated uncollectible current taxes with a debit. Remember, it has a credit balance, so we'll get rid of it with a debit, and we will replace it with a credit to estimated uncollectible delinquent taxes. And the last journal entries of the year is to close out the budgetary accounts. So you can see journal entry 13A is a reversal of the first journal entry. We're just reversing the budget. And journal entry 13B, and we're going to close out our operating accounts, close out our revenues with a debit. We will close out our expenditures with a credit, and you can see the difference is going to get closed to, in this case, restricted fund balance, because all of our monies are coming in and a third party is dictating how, or a law, in this case the law is dictating that this sales tax money can only be spent on the principal and interest of general long-term debt. So that is a term bond. A little bit more detail than the serial bonds because of the whole investing. But other than that, hopefully it's fairly straightforward to you. Just a couple of more concepts and we will be done. Here we go. Debt refunding. This is, I think, the last concept I want to go through with you for this particular study. refunding is just a fancy word for refinancing. So when a government wants to refinance their debt, maybe there was a large decrease in interest rates. All right, and of course, if we issued bonds at, let's say, 10%, and now all of a sudden the interest rate environment is 5%, clearly we would want to refinance. There are two types of refundings. There is a current refunding, and there is something called an advance refunding. A current refunding is when we issue new debt to pay off old debt immediately. Okay, but with an advance refunding, we actually don't pay off the old debt immediately. Effectively, what we do is we issue new debt and we transfer old debt to another party. We basically defease it. We get rid of it off of our books, but it still lives and breathes on somebody else's books and records. So typically we see an advance refunding. What we do is we give the debt and we also give money to a third party. All right, and so that is what a refunding is, and that's something you'll need to see the journal entries as you go through your homework studies, and we will discuss it when we go through our homework studies.